we might think we invest based on metrics and numbers and everything. Everybody invests on emotion at the core level. And so I don't think folks are kind of targeting a specific time or a specific, KPI in the economy that they're saying, okay, now's the time I'm going to start investing again. It's all, based on feel for everyone.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I am joined today by Josh Plave. Josh is an apartment owner and operator who specializes in helping investors use their retirement funds to passively invest. As a general partner on over 1,500 units across the country, Josh runs Wall to Main, where he provides education and investment opportunities structured specifically for IRAs, 401ks, and everything in between. Josh, welcome to the show.
Thanks so much for having me. Happy to be here.
Absolutely. We're happy to have you. Before we jump into this, obviously a great topic, especially now with the stock market doing what it's doing. But, kind of take us through, where you started and what led you to where you're at now.
Yeah. So I'm, as you might imagine, I'm a bit young to be kind of talking about retirement accounts and specializing in that kind of environment. But I actually have been doing it for about half my life. So I opened up a Roth IRA when I was about 16 years old. I'd worked that summer, and my mother and my grandfather, who were both CPAs, they suggested that I should really start looking out for my future. And that's kind of what got me interested in all this, just building stuff for the future. And so I started investing with that IRA and kind of slowly building it up over time. Fast forward about 10 years from that point, my mother and my grandfather, who I mentioned, they both unfortunately had passed away. But what they were nice enough to do was leave myself and my sisters with their retirement accounts, stuff they had been earning and building up for their lifetime. It wasn't a life-changing amount of money, but it was enough that I needed to make sure I was going to be a good steward of it. I was going to put it in something stable, not really whittle it all away on like some, meme stocks and popular hot things. So, I started looking at what I could do, how I could deploy those. I knew at the time I wanted to shift my investments away from the stock market, take away a lot of the volatility I was seeing in there, and move it into some form of real estate. I eventually landed on multifamily. It's where I sit now. And in the process of learning how to do it myself, I ended up building a company that helps folks essentially do what I was doing: take their retirement accounts off of Wall Street, move them onto Main Street, stabilize their income stream in their retirement, and make use of the funds they currently have.
Wow, that's awesome. 16-year-old opening a Roth IRA. I love it. Awesome. So you have all this experience now. You've obviously, like you said, created Wall to Main. Unless you've been living under a rock, we all know what's happening in the economy here, and the stock market obviously is down, right? So what does your conversation look like with investors, even before, right? Let's start with when the stock market's ripping and, everybody's having a good time versus, right now.
Yeah, I mean, so it's interesting because, over time, commercial real estate especially has fared really well compared to the stock market. The last 3 or 4 years, the stock market was doing like 20-30% annually. So there was a short period there where it's like, people were wondering, why would you move to real estate? But, over a lifetime, it's the way to go in my mind. But, generally when I was first doing it, I'm an analytical person. So I was trying to take a look at kind of, I was 25 at the time, I think. And I was trying to figure out, hey, over my lifetime, like if I move into maybe not just one asset class, but if I'm really focusing on one thing, what's that going to do? And so I kind of started looking at average annual returns, taking a look at the volatility between both. And I ended up learning that multifamily investing is about 58% less volatile than the S&P 500. And so this is kind of how I speak to my investors. I let them know, it's the same situation I'm dealing with my dad. I like to use this story because he's starting to prepare for his retirement. And so we want to make sure he's not in something that's volatile. So as he goes to retire, his account balance doesn't just plummet. And you certainly saw that, when, in the last couple of months, when he hadn't liquidated some of his funds, he had a lot of money in bonds, and those started to tank, and he lost a good amount of money. And so we're trying to avoid those types of things and move him slowly over into a more stable asset class, so that when he does need to access the funds, they're there, they can backstop him, he can move off of active income and have a nice passive income stream.
Yeah, absolutely. That's a big one. I know when I worked in the stock market, I had, retired clients or close to retirement. And man, if that market dropped, that's a lot of stress because, maybe they're at retirement and income is no longer there. So this is all they have. And watching that slip away is, can be heartbreaking for sure because, listen, if you don't sell, it's not yet a loss, but, they don't have, 5, 6, 10 more years for the market to potentially recover. And that's where that volatility play really can be leveraged. So when it comes to those conversations, are you, maybe if they're a little younger, are you maybe talking to them more about finding some appreciation deals more than cash flow versus, as they reach retirement, maybe switching to cash flow?
Yeah, absolutely. I think there's kind of a two-pronged approach here. And myself, I take a slightly different approach as well, because I'm younger. Most of the properties that we acquire are going to be like a value add type of a property. And so they do ultimately cash flow, but there is that component where we can force appreciation and really grow, not just the value of the property, but overall, balances for the actual investors. And so younger folks, yeah, I mean, not only is it going to be more stable, but consistently it's going to, outpace the stock market in my mind. And statistically it does, by just, we have control over the actual asset. We don't have to be at the whim of, maybe a CEO who might, launch a tirade on Twitter and possibly buy them and not buy them and, be at the whim of somebody else. We get to control our own fate, decide what's happening with the asset, push it up, and then, sell it to the highest bidder.
Yeah, absolutely. And so with that, obviously, we got to get them to the self-directed side. So do you work with an affiliate on that end?
No one specific person. I'm kind of like shifting around, and it depends on who's providing good customer service now. Currently, I use a company called Resure Financial. It's run by a CPA named Bernard Reese, and this guy can talk your ear off about all the intricacies and everything.
I've had him on the pod. He was a
absolutely.
great guest.
Yeah, I'm sure it was a long one. He's very knowledgeable, and so he sets up accounts very well and provides some ongoing education for the space. So I love that concept and approach he's bringing.
Yeah, absolutely. That's funny you mentioned him because I'm on his list too, and he provides so much information, which is obviously, for something like this, really the biggest key is education, right? Because so many people just don't realize they have this power when it comes to their retirement accounts. So we mentioned IRAs, 401ks, everything in between. Are you working with 1031s as well and kind of all of that? Also just regular investors?
Yeah, absolutely. We use cash investors, so we help them as well. 1031. There's no 1031s in the IRA space, but we use 1031s on all of our. We've got a deal that was going recently, and we're using 1031 funds there. So just another avenue that folks can use to get involved.
Yeah, absolutely. I love it. And so on the operation side, obviously you guys are acquiring, like you said, you got over 1,500 units. Anything, obviously a lot changing there, but anything changing for you guys specifically in terms of, maybe some new markets, taking some markets off your list?
Let's see, taking markets off our list. The first properties we acquired were in Lubbock, Texas. Probably scratching those off my list. The things went okay. It was just softer than the rest of the country. When the rest of the country's on its hair, and your assets they're still doing well, but they're not doing as well as other places, you realize there's maybe more opportunity somewhere else. We're recently now moving into the Chattanooga, Tennessee market. I just recently moved west or east, and when I was doing so, I was considering three places: Charlotte, Asheville, and Chattanooga. It's a great place for families, and so we see a lot of consistent growth there. There's tons of like family activities to do, and so like that growing market, it's small. There's a lot of there's limited supply, limited new builds as well, and so we buy kind of all across the Southeast. We're heavy in the Sarasota, Bradenton, Southwest Florida market, and that's kind of like between there, Atlanta, and Chattanooga. That's essentially where we're looking right now.
Nice. Yeah, we were talking offline about, I'm potentially going to be moving. Chattanooga is actually one of the places also on my radar. Obviously great market, also logistically for the other markets like we had mentioned. And, it's crazy to hear it being mentioned now amongst operators because, I've had some family there, like my whole life. And so I've been there a couple of times and it was, small town. And now you're hearing it mentioned with some of these top operators and you're just like, wow, place is blowing up, which is awesome to see. And so, in terms of the asset multifamily, are you guys really that C-class value add, everything in between?
Yeah, we originally started off in C class. Now that we're seeing, there was a lot of cap rate compression where you're starting to pay high dollar amounts for every door in comparison between a C and a B. And when you're only paying a small premium to go up to a B and you're paying a lot to get a C, we're really trying to move into that B and above, territory until maybe C's kind of cool off a bit. They also are going to have, in my mind, the largest struggle with collections going forward if there's any kind of issue with unemployment and everything. So yeah, we're moving into the B's and the A's. Anything with a really a value add component. We do a lot of interior renovations, exterior we do as well, but it's the same business plan essentially copied across multiple assets, and so it's easy to execute in our minds.
Yeah, absolutely. And are you guys vertically integrated property management in-house as well, or?
No, we use at least usually about two different property managers on across most of our properties. Yeah, we're not specialized in-house. I'd rather let somebody who's an expert on that handle it.
Yeah, absolutely. I don't blame you there, but I feel like a lot of times the in-house property management comes when you just can no longer find good property management, and as long as you have a good partner, very invaluable, of course, especially if you're getting into new markets. Maybe they have a presence there already. So as we move forward, as things are a little uncertain, obviously, I'm sure now more than is this a time now where you're having more conversation, more people reaching out about their retirement accounts?
Yeah, it's definitely it's an interesting dynamic. A lot more people are reaching out because they are looking for other places to chase returns, and so they're looking around. But I will say there's a lot more people who are now more tepid. People are a lot more fearful of any kind of investment right now, and even if cash is kind of the return on that is dwindling away because of inflation, I'm finding a lot more people are actually holding on to their cash, and it's definitely becoming more difficult to raise capital right now. Even if I'm seeing more people reach out, they're curious, they're interested, and they definitely like the concept. They're either waiting for a different opportunity or different time down the road, or they're just maybe a little cautious right now.
Yeah, absolutely. I'm seeing the exact same thing. Are you getting any specifics as to what they're waiting for? Because that's one of my big questions, because one thing I like to say is, it's fine, right? I understand, you want to kind of see, but if you're really paying attention, that, things aren't going to change in 3 months, right? 6 months. And if you wait too long, then it becomes, now I have no idea how to get in. So anything specifically that they think they're waiting for?
I mean, honestly, on the retail investor side, they're not like big institutions who have these like really set metrics. I think there's maybe a small subclass of investors who do have that sort of thing. But even, I mean, myself and, pretty much every retail investor, just individual themselves, we might think we invest based on metrics and numbers and everything. Everybody invests on emotion at the core level. And so I don't think folks are kind of targeting a specific time or a specific, KPI in the economy that they're saying, okay, now's the time I'm going to start investing again. It's all, based on feel for everyone.
Yeah, it's so true. And as much as we like you said, want to act like it's based on all of these dynamics, because really when you break it down, if you lined up 5 top operators in the Southeast markets, the returns are pretty much identical, right? Which means you can really kick the can down the road and find that, 6-8% return, yada, yada. And so it really becomes, that emotional know, like, and trust, with who you choose.
Yeah, absolutely. I think that's the right approach. Right.
Yeah. I love it. Well, this has been awesome. Really appreciate the insight here. I know retirement accounts, really just got to get the word out, and hopefully more people can figure it out. So we'll jump to the final 5 here. First question: best advice you've gotten from a mentor?
Oh, wow. I honestly, it's not just mentors, but it's also books. A lot of people point towards this one direction. It's focus on one thing. When I first got into the business, I was focusing on like a lot of stuff. I was trying to acquire deals, raise capital, shadow people, maybe wholesale and flip. I don't know. I was all over the place. And when I started focusing, very specifically on building out, my self-directed retirement company who was helping folks invest in multifamily, raising capital, I specialized in one thing, and I can give 100% to one thing. And once I kind of master that or get it to a level where it's running itself, I can then focus on another topic. And that might take a few years, but I'm totally okay with that because I'm setting myself up for a lot of success down the line.
Yeah, absolutely. I think we're all guilty of that, especially in the beginning, right? Because you may have your sight set on something, and then maybe you read a book or listen to a podcast, and the guest is successful in this thing, and you're like, oh well, maybe I should try that too. And so you really can be spread too thin, and then nothing actually comes to fruition. What is it about your career that makes you feel like you're fulfilling your why?
I mean, as you might see from my background, for those who are listening, I'm in a bedroom that is now converted to an office in my house. So I mean, I have a 1.5-year-old. I get to be with her every single day. I have a lot of things that are automated that help run my business. And so like the story I like to tell is the day she was born, we were in the hospital for, about 48 hours. And by the time I got out, I had actually gotten pinged from 2 or 3 different investors who had signed up and wanted to get in touch and set up phone calls and everything. So I knew that everything I had built was in place, and people were able to see, reach me. They were able to see the value that we're providing without me having to necessarily be there specifically, providing touch points for them. I could get on the phone afterwards. And so it allows me to have a much more fulfilled family life and just be around and more available to my family.
Gosh, I love that so much. That's so awesome. And congratulations on the baby. I'm sure that's been amazing, especially being able to be present, like you said.
Yeah.
Favorite non-real estate or investment related book?
Okay, so the one I would say has been most impactful, that's actually changed recently. So I guess it's non-real estate, it's business related. I read most of things are either business or self-help or something. And the most recent one was Who Not How. And so it really is focusing on, instead of you taking care of the work, you find someone who's an expert, kind of like what I was saying with property manager, even though I'd like to bring that in-house someday. Finding someone who's an expert before you can tackle that concept expertly by yourself is really important. The line that kind of got it imprinted itself in my mind the most was, you're buying other people's time. So you get time yourself because you are taking other people's time to fulfill whatever project that you've got in mind, and you can help, they can help you achieve whatever your dreams are.
Yeah, absolutely. When I first signed up for my mastermind, that was the book that came in the care package. And it's a easy read, but so powerful, especially when you get to the part like you just said, where you realize that you can actually multiply your time by, delegating these tasks, which, as entrepreneurs, solopreneurs, that can definitely be the most challenging part, is letting go of that control.
Yeah, that's why it was so good for me, because I'm 1,000% guilty of the how syndrome.
Yeah, I think we all are for sure. If you could have any superpower, what would it be?
Oh man, any superpower. I mean, I guess it would be that. It would be the ability to take my hands off. I really like figuring stuff out. I have a very curious mind, and so I do a lot of my own marketing. I try to figure out how I can, build stuff. And I genuinely, I know it's kind of an extension of the last one. I want the superpower to be able to just sit back and find the right people who can take care of everything for me.
I love it. Awesome. Last one. What's the best way for people to get a hold of you and learn more?
Yeah. So I provide a lot of education and kind of help people understand what the returns are after, there's a certain tax associated with investing with self-directed IRAs. So I offer a calculator that can help, solve all of that. So if you go to ubitcalculator.com, UBIT calculator.com, that'll show you kind of like how you can understand what you're getting into if you decide to invest with an IRA in multifamily.
Awesome. We'll link that in the show notes, make it super easy. Josh, this has been awesome. Thank you so much for your time.
Thanks a lot for having me.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.